All right, thank you so much. Thanks everyone for attending today to this Investor Inspiration presentation. And once again, my name is Stephen Primo. Today I'm going to give you a great educational webinar where I'm going to really be teaching you what I feel is the right way to trade tops and bottoms. I know this is a very common way in which people are taught, and I know I was when I first started trading, that we're always looking to buy low and sell high. And I'm going to show you something that will really go against conventional wisdom, but I think will increase your odds for success. For example, if we take a look at this first chart here in Apple, I'm going to show you a simple technique that you can start using as early as today, once we finish this presentation, where if you were able to locate a top such as this right here, you could have taken advantage, hopefully, of the very nice move to the upside for the next 22 points. So I'll teach you this entry technique once again. My name is Stephen Primo. I am the president and founder of Specialist Trading, and Pro Trader Strategies is my sister site. I teamed up with Pro Trader Strategies around 8 years ago, where all we do is teach and mentor students all of the things that I've accumulated in my actually 40 years of trading now. I'm going on 40 years starting this year. I started out trading on the floor of the stock exchange. I was on the floor for 16 years. 9 of those years I was a specialist, which just mainly didn't mean you were any more special than anyone else, but that you made markets. So if anyone wanted to buy or sell a particular equity, you had to go to the trader who specialized in that. That's where they get the name specialist. I traded through the crash of 1987 and then the bull market that followed. So I've seen and traded and been involved in just about every market environment you can imagine. And because of that, I know what works in terms of consistency and I know what doesn't. So this is what we do at Specialist Trading and Pro Trader Strategies. We just educate and mentor our students around the world, and now actually over 110 countries in virtually every state in the United States, all the things I've accumulated in my 4 decades of trading. Now today, once again, I'm going to give you a great entry technique that you can start using right away. But before we do, we are required to show you this, so please take a moment to view our disclaimer. I'm going to show you a lot of performance results, a lot of charts in all markets and all time frames using this technique, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. So once again, we are required to show you this, and as you're taking a brief moment to view that, I would also like to invite each and every one of you to follow us on Twitter. You may want to copy down our handle right there at SPCLST. Every day I post something anywhere from just conventional wisdom, little bits of wisdom I've had along the way, to actual signals that some of our strategies have generated in all markets. So feel free to follow us on Twitter. Now, first and foremost, I just want to say we are an educational company. This is where we differ a lot from other presenters, in that we're not about having chat rooms and trading rooms for you to come in and watch and see what we do. We don't believe in that. We don't want to force feed you signals, because in my 40 years I found out that that's really a recipe for disaster. The only thing that I've learned is that no two traders should ever trade alike. And we feel that, you know, if we're force feeding you signals and telling you what to do, we're basically telling you how to trade. And that goes against all of our philosophy of specialist trading. So what we're trying to do is teach you, as you see here, not force feed you, but teach you how to trade with the specialist edge. This is the same edge that turned my trading around. For my first year or two on the trading floor, I struggled tremendously. In fact, I didn't think I was going to be around on the floor trading much longer. I make no secret about this in my webinars and my presentations. But I was lucky enough to have a couple of mentors myself who had been trading for roughly about 30 or 40 years, who were able to turn my trading around. And so this is what I do. After all these years, I'm doing the same thing and teaching and mentoring students around the world so that you can trade with the specialist edge. This is the same edge that was able to turn my trading around, which I believe has been able to sustain me for 4 decades, and hopefully it'll be able to do the same with you. So this is what I'm going to be teaching you today. I'm going to be sharing with you what I feel is how most people trade tops and bottoms, buying low and selling high. I know this is the way I was taught, and this is the way I first started trading. So let me show you what I mean here. We're going to start out with stocks, and I'm going to start out showing you some older charts. So don't worry. I mean, towards the end of this presentation, I'll show you examples of this entry technique that happened just within the last week. But these older charts are simply for educational purposes so that you fully understand the process. Now let's look at some stock charts here. In fact, let's look at this older chart of Caterpillar Tractor. Now, conventional wisdom tells us if we're trying to pick bottoms and tops, buy low and sell high, one of the best ways to do it is by using an overbought, oversold type of tool or indicator. In this instance, we're just going to look at the bottom tool, which is a slow stochastic indicator. Okay, this is nothing we edited. We didn't change anything, and it's virtually on any charting software package. If you just click on your slow stochastic, all I know, don't ask me to explain the inner workings of the tool indicator. All I know is that this upper horizontal line here is the overbought threshold. So it basically tells us that anything above here, the lines cross, the stock, the future, the currency pair is too high, and you should look to sell it. And anything below here is oversold. So conventional wisdom just simply tells us that if the indicators, whatever we're looking at, comes into that so-called oversold area, well, this is actually a buy. And so let's just say that you applied this to Caterpillar tractor and you purchased here. Well, it worked out pretty well. You would have bought here, and you see that the stock went right up. And so all you have to do is follow the indicator. Remember, this can be any indicator. It can be any other stochastic. It can be something that you devised. It can be something that someone says on TV that the market's overbought or oversold. But as we're following this particular slow stochastic, we see that it goes into the so-called overbought territory. So the lines cross. That's your sell indication. So you exit your long position, and lo and behold, the stock falls out of bed. You know, at this point, you think you're going to retire early because it just can't be this easy. You continue to follow the tool, the indicator, and now once you see the lines cross and you're in the so-called oversold, you cover your short. Now you buy again, and you're excited about how much money you're going to make on this one, and it doesn't go any higher. In fact, it goes much, much lower. But that's okay because you've already made some good money on the first couple of trades, so you do what we call doubling down. You're going to buy some more. So after all, you don't need it to rise that much to make some money if you've doubled your position. So you wait for the lines to cross again, you jump in again, and it goes just a little bit higher, but now we're going even lower. So now you're basically breaking even from all the profits you originally made. So you're going to triple up. You're going to really, put all your eggs in one basket and hope that it goes up, and that way you can make everything that you lost back. So you buy some more by tripling up, and once again, it just continues to go lower and lower until you've lost everything you made in the first couple of trades and given everything back, and now you're in the loss column. Now, does this look familiar to anyone? Okay, I know it does to me because this is the way I used to trade when I first started trading with this type of conventional wisdom. Now, it just doesn't stop for stocks. Let's say someone says, well, Steve, I don't trade stocks. I trade the E-mini S&P futures, okay, intraday. Okay, well, let's look at a 5-minute chart, an older chart of the E-minis. Same principle applies. We're going to apply that overbought, oversold tool. Now, as we see here, we have the same tool telling us that we are overbought, so we decide to sell, and the future goes down. So that's pretty good. We've got a nice profit. And then once we go into the so-called overbought area, we buy back our shares, or I should say our futures. We cover our short, and we go long, and works like a charm once again. So we're doing very well. So now we're starting to think, well, maybe I shouldn't have been trading stocks. Maybe this works much better for trading the futures on an intraday basis. After all, this is a 5-minute chart. So now we get to the so-called overbought area. So you're ready to exit your long position. Now you want to go short, and this time it doesn't go lower. So you double down, triple down, and you're right back to where you started again. You've lost everything. In fact, you've lost more. And once again, it doesn't matter if we're looking at stocks or 5-minute futures. We can still apply this to currency pairs, to the forex markets. As we look at an older chart of the Swiss franc, we see here that we are using the same stochastic slow overbought, oversold tool, and we are in the so-called overbought area, so we decide to sell. And it doesn't go lower, we're just kind of going sideways, so that's okay. But then if we follow the tool once again, it goes back to overbought. So we decide to sell more and more and more, and in this case, we never even had a winning trade or two. We just lost on every trade. And I see, trading this way, it is similar to gambling in Las Vegas. It's similar to playing the slot machines because they are designed to furnish you with winners every once in a while, to give you this false sense of security that you're doing well. Because the longer you stay there, they know that they're going to take all your money. Now, trading tops and bottoms the conventional way is just like trading or playing the slot machines, because every once in a while, sure, you will get a winner. And you'll have this false sense of security thinking that, well, it's working, I'm doing okay. But ultimately, if you keep doing that over and over again, you will eventually give back everything you made. Now, trust me, take it from someone who's been there, because this is the way I used to trade. And once again, my first year or two on the floor, I didn't think I was going to be there much longer because this is the way I traded, and I didn't have anything to show for it. So As a matter of fact, my mentors saw how much I was struggling. They saw how, desperate I was and how discouraged, because I was doing all the right things. I was trading overbought and oversold tools. I was going to all the seminars. I was reading all the literature, but nothing seemed to be working. And so my mentors taught me something that was very, very difficult to grasp, and I'm going to share it with you right now. But ultimately, once I did grasp it, it changed everything for me. And what they said was, Steve, there is no such thing as overbought or oversold. Okay, I'll say that again. I know it's hard to digest here, but trust me, there is no such thing as overbought or oversold. I know you hear it on a daily basis. You probably say it yourself. You hear it on TV. You hear it in webinars. This market's overbought. It's oversold. It's too high. It's too low. But think of it. Look at any chart and look at it'll go as high as it wants to. We've all seen markets go high and high for months, if not years. And we've all seen markets come down even to zero. Does anyone remember Enron years ago? Okay, markets can go as low or as high as they want to. So it's really foolish. It's a recipe for disaster to think that you can pick a top or a bottom. There's just no way to really do it with consistency. So that was very difficult for me to grasp, because I had been always taught, well, if a market's overbought, you sell it. And if it's down too low, if it's oversold, you buy it, okay? So once I did grasp it, I said, okay, I've done the research. I guess you're right. I've looked at a number of things that can go higher and higher and lower and lower. So then what is the correct way, the right way to trade tops and bottoms? So here's what my mentors taught me. They said, Steve, the right way is simply to go with them. So what does that mean? What does that mean, go with them? Well, here's the entry technique I'm going to be sharing with you today, okay? And once again, I know a lot of you will say, boy, your eyes will light up and you'll think, this is amazing, but Steve, where do I exit? Where do I place my stop? Where do I, how many shares or contracts should I use? Remember, today we're just giving you the entry technique, but it's pretty much just about the gist of everything. If you've been trading for a little bit, you'll know where to protect yourself. You know when to get out. It's just really all about entering with a high probability entry. So here's the technique we're going to be sharing with you today. Let's start out with the same chart we looked at, Caterpillar Tractor, okay? Now the first thing my mentors taught me is they said, Steve, regardless if you're going to be using this technique, regardless if you're looking at stocks, futures, currency pairs, and regardless of what time frame, it makes no difference. You must always apply one thing prior to that, and that is the 50-period simple moving average, okay? So I want you all to have a 50-period simple moving average on your chart at all time. I don't care if you day trade tick charts or if you're an investor that trades monthly bars. It makes no difference. And what you want to do is, prior to entering any trade, I don't care if it's this technique I teach you today or any strategy you're using, you have to ask yourself one question. And that question is, where is price in relation to the 50-period moving average? Okay, I'm going to say that again. You may want to write that down and put it on your post-it next to your screen. Where is price in relation to the 50-period simple moving average? Because you'll only come up with two possible scenarios. If price is above, then you will only look to go long. In other words, you'll only look for structure to buy. But as we see in this case, if price is below, well, then we're only going to be a seller, all right? It doesn't mean we're going to sell at the market. It means we're looking for structure to go short. We are in no way going to even consider going long. So in this case, we've just eliminated a lot of our losses, because that's how we lost on this trade, trying to pick a bottom. So here's what we want to do. Since we're still trying to look at bottoms, what we want to do is we want to exploit them. As we look at the tool here that we're using, the overbought, oversold indicator, remember, every time it told us that the market was oversold, we want to identify where that is, okay, as we have circled in red. Every time we went below that so-called oversold condition, that's what we want to look for. And then once we have found what those oversold areas are, we want to identify all of the little bottoms, the short-term bottoms that were created. So as you see here, a little bottom is simply a low followed by a lower low and then a high low. We have a little bottom here. This is where people thought, well, we're oversold, we're going to bottom out. And here's another place where we were in the oversold and we thought, well, we're going to bottom out. And then another place. So they're marked by these small little red horizontal lines. And what we want to do is we want to exploit them, because every time they are violated by one or two ticks, we're going to sell. And now you see where before we had a couple of winners and then we gave everything back. Now we have nothing but winners. You see here how easy this is? Why? Because we are in sync with the 50-period moving average, and we are exploiting oversold conditions because we finally have grasped the concept that there is no such thing as oversold. There's no such thing. It doesn't exist, okay? So this is what we're doing. And remember, you don't have to go short the stock. I know a lot of people don't like to go short stock. You could purchase the puts. You could purchase some type of option strategy that keys to the downside. It's up to you. These are just entry points. Let's look at that other example we shared with you earlier in the E-mini. Here's the 5-minute chart. We have the same slow stochastic. It doesn't really matter what tool you're using. This could be any other type of stochastic. It could be an indicator that you devise. It could be something that someone says in a chat room. It doesn't matter. We are just going to exploit if something says it's overbought or oversold. So don't get caught on the idea that it must be this slow stochastic. It can be anything that has an overbought or oversold condition. All right, what's the first question, though, before we do any type of trading? What's the first question we ask ourselves? Where is price in relation to the 50-period moving average? So now we see in this scenario on a 5-minute time frame that price has always been above. So should we have even considered shorting the 5-minute chart of the E-mini? Absolutely not. And that's where we got all of our losses. If price is above, the odds will eventually be in our favor to only take long scenarios. So if we're only going to be going long, that means we want to exploit so-called overbought conditions. Why? Because there's no such thing as overbought. It doesn't exist. So if there's no such thing as overbought, we want to identify where those short-term tops were, where everyone thought, well, see, it was overbought, we stopped there. Because we know once we go through it and violate it by 1 or 2 ticks, we're going to go higher. So as we saw before earlier, if we had 1 or 2 winning trades, we gave everything eventually back. But in this example, we had winners on virtually every scenario, okay? Every setup. And lastly, let's look at the currency pairs, the Swiss franc. Now remember this, we had nothing but losers. We kept selling and selling and selling because why? Well, because we were told we were supposed to sell when something is overbought. First thing we ask ourselves, where is price in relation to the 50-period moving average? And you see how simple this tool is? It doesn't cost any money. It's something that you can start using right away. It doesn't matter what market, it doesn't matter what time frame, but always ask yourself, where is price in relation to the 50-period moving average? If I'm in sync with that simple question, then it's okay to take the trade, regardless of what strategy or system or method you're trading. But in this case, since we're using this entry technique, we're only going to be going long. Okay, we're not even going to consider going short or selling the Swiss franc. Why would you go against the overall trend? So if we're only going to be going long, we want to exploit the so-called overbought areas, overbought conditions. Because why? Because there is no such thing as overbought. It doesn't exist. So we locate where the overbought scenarios are. We identify where the short-term tops were made during the so-called overbought areas. And then once we trade 1 or 2 pips above, those are our entry points. And now before, where we had nothing but losing trades, we have nothing but winning trades. So you see how easy it is to become a consistent trader if you're in sync with the overall trend and you don't subscribe to those worn-out conventional wisdom that tells us that to buy low and sell high based off overbought and oversold. It doesn't exist, all right? So that's the basic concept, all right? You learned what we're looking for. Now let's apply it to some more recent current charts, all right? Let's look at some more examples. Let's start out with stocks for all you stock traders. Let's look at KLAC, okay? Now, coming into this trade in September, October, we were below the 50 period, so we're only looking to sell. But if we're going to use this technique, we never got into the so-called oversold area, so there's no reason to go short this. Now, once we got into October, mid-October into November, we see that we had multiple closes above the 50, so now we're only looking at things from the long side, regardless of what technique we use. And now, since we're only looking at the long side, look at all the overbought scenarios, so-called overbought. So here, all we have to do is identify where the tops were, and we always tell our students that in our courses that take this technique that you get the most bang for your buck if you take the very first setup, okay? So let's say you had taken this very first setup right here to go long once it was violated. Well, seeing that, and if you were lucky enough to hold off until the beginning of March, that's 16 points in your favor for the next 3 or 4 months. You didn't have to rely on any news. You didn't have to go to a chat room. You didn't have to look at any earnings reports. Everything was right in front of you on the chart. Okay, this is the basic philosophy behind specialist trading. Everything you need to know is in the chart in front of you, because the market usually tells us what it wants to do in advance. The only trouble is, myself included, we've all been taught not to listen to the market. We've taught to listen to some guru on TV or some guy on a webinar. We're taught to listen to the guys in a chat room or a trading room. We're taught to listen to earnings. But there's no more consistency in that than in throwing a dart at a dartboard. Listen to the only thing, the thing that is the source that's giving you the signals. That's the market in front of you, and it will tell you what it wants to do. The very easiest way to find out is by applying that 50-period moving average, okay? If price is above, what is the market telling you? It's telling you that the overall trend is up, and it wants to go higher most likely. All right, let's look at SCG. Once again, we are above the 50-period moving average coming into the beginning of the year here. So this is a good buy scenario. Here's the top that was created, but we never went above there. So there was no setup to go long. Remember, we have to trade 1 or 2 ticks above. So we're not going to even consider anything, and now we crossed below, so now we're switching gears, and we're going to be a seller now. All right, so we have so-called oversold here, oversold here. Let's find out where the bottoms were. Just a couple. Had you taken the very first one in the middle of January, well, that was a quick 5 points to the downside in just about a month's time. That's a nice quick little trade there. How about Apple? And this is the chart I showed you in the beginning. Remember we talked about how I'm going to share with you this technique where had we identified this top right here? Well, we're identifying this top because we are above the 50-period moving average. All right. Earlier we were below, but we didn't have any setups because we weren't in the so-called oversold. So now we're just looking to go long. Since the beginning of December, we're only going to be a buyer in Apple. Well before this trend started, we knew that we were only going to be a buyer. Why? Did we look at the earnings? Did we listen to some trading guru? Absolutely not. We listened to the only thing we should be listening to, the market. The market was above the 50, so what's it telling us? It's telling us it wants to go higher. So let's use this technique. We simply identify the overbought areas. We identify where the tops that were created, and if we had taken the very first one, that's how you would have been able to potentially capture 22 points to the upside coming into March. See how simple it is? There's nothing. You see, trading is really simple. It's just as traders, we make it more complicated than it has to be. I think we're all taught from the very beginning that the more complicated your system or your strategy is, the more valid it will be and the more profitable it will be. But I'm here to tell you, in 40 years of trading, it's actually, I've learned it's the opposite. That the best and most consistent traders are the ones that have the simplest of plans and they have the least complicated of plans. So keep things simple and you'll get onto that road to consistency much quicker. Letter M, okay? Here once again, coming into December, we are above the 50 period. We have a top that was created and we're in the overbought area. So this is a good setup to go long. But guess what? We never traded above it. Remember, that's the rule. We have to trade above the so-called overbought area. We never did. So we simply wait and look for another setup. Now, once we crossed below the 50 in December, well, now we change gears and we're a seller. So we simply look for oversold. And look how long it's been oversold. All this entire time. If you had tried to pick a bottom for this month in December into January and February, you would have lost a lot of money based on something being oversold. See how silly it is to try and use that tool? It's much better to do what my mentors taught me, to simply go with it. So how do we go with it? Well, we exploit the so-called oversold. We find where the bottoms were, and had you taken the very first setup, well, that's 8 quick points in 1 month to the downside. And once again, you could have purchased puts, options, anything you wanted to. Let's look at another example here, FOSL, fossil. Okay, as we see here, we are having a very nice setup to go long, but that's where we had to trade above in order to go long, and we never did. So coming into December, January again, we had a very strong move to the downside. Now someone in hindsight would say, well, Steve, yeah, well, how did you know that? Well, we knew that in December. 2 or 3 consistent closes below, we knew that, you know, even though you wouldn't have sold at the top, we knew that we should not be long this stock because it's telling us it wants to go lower because it's below the 50. So all you have to do is sell in the so-called oversold areas. Had you taken that very first setup here, that would have been 10 bucks, 10 points in your favor coming into this month in March. All right, now Tesla. Tesla has been going straight up. A lot of people can't believe it. I know it's an expensive stock, but you could have easily applied this technique I'm sharing with you today to options. Here we are. As early as mid-December, we had consistent closes above the 50-period moving average. So what was the market telling us? Well, before it had this tremendous rally, it's telling us it wants to go higher. You don't have to look at earnings or find out what's going on with the company to know that the market wants to go higher if it's closing above the 50. So if it's doing that and we want to go long, we can use this technique by exploiting the so-called overbought. And once again, anyone relying on this indicator to sell would have been foolish to do this, because look at how straight up we went and how long we've been overbought. And remember what I told you, there's no such thing as overbought. Well, this thing was overbought well back here. Well, if it's overbought here, it must have been really overbought here. It must have been really overbought here, and it must now be really overbought here. I mean, do you have enough money in your account to continue to sell or get out of that? It's much better, as my mentor, to simply go with it. So all you have to do is identify the tops. Had you taken the very first one back here in December, well, that's 80 points in your favor in the next 2-3 months. Not a bad way to trade, huh? And finally, QCOM here, as we look at stocks, the same scenario. We have overbought here. We wanted to exploit it, but we never traded above there, so there's no way to go long. And now that we switch gears, we're looking to go short. And starting in January, mid-January, we could have easily taken advantage of a quick 12-point drop in this stock. Obviously, some news came out where the stock gapped down much lower. Something came out with the earnings, the company, or something in the sector caused the stock to really gap down and go lower. Well, that's funny because the market was telling us a month prior, with all these closes below the 50, that it was going lower. So do you see why I say there's no reason to overcomplicate your trading, waiting to listen to outside sources to tell you what to do? The reason why most traders fail is because you rely on someone or something to tell you how to trade. At Specialist Trading, we don't tell you how to trade. We teach you and mentor you and then let you make your own trading decisions. All right, let's look at other time frames, okay, in case you don't just trade. Here's a weekly chart of Facebook starting in October of 2013. Where is price in relation to the 50-period moving average? Price is above. So if you're an investor or a swing trader, you would have no reason shorting Facebook going back a good 3-4 years ago. If you wanted to use this simple technique, here are all the so-called overbought areas. And guess what? 82 points to the upside the last 3 or 4 years if you'd use this technique. And it doesn't just have to be a higher time frame, it could be a lower time frame. Now here's an example just to show you that it works in any market, any time frame. This is in Snapchat, the IPO that came out this past week. I'm not saying that you could have traded this, but this is the day it came out. This is a 1-minute chart, okay? Where is price in relation to the 50 coming in this first couple of hours? We're above. And then once we cross below, you see how price fell out of bed, okay? It doesn't matter if we're looking at a weekly chart or a 1-minute chart. We can use the same concept. As we're going up, you could have made 3/4 of a point off this. Now this is, you would have had to trade multiple shares, but we're just showing you how the concept works. And then once you had consistent closes to the downside, you can simply go short. Nothing changes. So that you would have made over 3 points in the first day of trading. If you were trading 1,000 shares, that's $3,000 just using this simple entry technique. Let's go off news. I know a lot of people say, well, Steve, I'm sure this looks great, but if news comes out, there's no way you can substantiate this. The news will change everything. Well, I'm not going to tell you that this is guaranteed to always do better than news, but oftentimes you will find that this technique will tell you what to do in advance of the news. For example, a couple of weeks ago, Yahoo Finance reported that HP's earnings showed that the PC market is finally starting to recover. And so the market really took off, as you see here. At least 7 Wall Street analysts raised the price targets on HP stock after the company's first quarter report late Wednesday. So if we look at the chart, well, guess what? Here's where the earnings came out, all right? And so this is where the analyst, after hearing the earnings, decided that it's going much higher. But if we use the simple technique of the 50-period moving average, a full 3 weeks prior, the market was telling us it was going much higher. Why? Because we had 1, 2, 3, 4, 5 closes above. So all we want to do is exploit the overbought area, because we know there's no such thing as overbought. And you could have identified the tops, and it would have been a quick 2.5, 3 points to the upside just using this technique. And I know it's not a lot of points, But that represented a 15% gain in the stock. Okay, how many people can see a stock go up 15% in just like 2 or 3 weeks? All because you're listening to one thing, the market. All right, let's look at an entirely different market, entirely different time frame. Here's an hourly chart of the E-mini futures. Okay, this was going in February, into mid-February, all of the month of February, I should say. Now, at this point, in the first week of February, we had consistent closes above the 50. Nothing changes just because we're looking at an hourly chart, and we remained above it coming in all the way into March, okay, coming into this past week. Do you think you could have used this technique to help you trade the E-mini? That's 105 points in 1 month, or roughly, if you just traded one contract off this first signal, which we advise our students, this gives you the most bang for your buck, that's $5,000 per contract. Now, we're not saying that every trader would have stayed in that entire time, but this is what you have to work with. You had 105 points to work with. Some of our students would take a couple and get out. Some would go for 10 or 20. Some would be lucky enough to stay in as long as possible. Remember, we're not going to tell you how to trade. We're going to give you all the different options for entries, exits, stop placement, and then let you decide, because that's our philosophy. The only way a trader can become consistent to trade 20, 30, 40 years down the road is by making your own trading decisions. The trouble is, most traders don't know how to do that because we've always been trained, myself included, to follow someone or something else. Well, this is what we do at Specialist Trading and Pro Trader Strategies. We teach you all the different choices and variables you have, and then mentor you and let you decide. Now, here's a 2,500 tick bar just last week, okay? You see we had a nice gap up to the upside. Now, obviously, we're above the 50. And we stayed above for the good portion of the day. So if you wanted to use this technique on a tick chart, here are all the so-called overbought areas. You could have identified all of the short-term tops. And if you've taken the very first one, well, that's 15 points or $750 per contract you had to work with. Now, the last one, we never got above. And if you wanted to carry this position overnight until the next day, you could have, because you had 2 sell orders. You would have gone in short the next day, okay? And then lastly, just because we're looking at the tick charts on the E-mini doesn't mean we can't use it on the Forex markets in an entirely different time frame. Here's a monthly chart of the British pound going back to 2015. All right, we were above the 50. We would have gone long if we traded above here, but we never did. So we now turn to go short. Now, if we were investing, if we were holding positions that long in the British pound, this would have told us to get out right here. All right, we would have known well in advance, at least not to be long the British pound if we were an investor. But if we're a trader, well, we could have used this technique to identify so-called oversold. And you see right here how it's just silly to try and think that something is overbought, oversold. If we were oversold here, don't you think we're oversold here as well? It's just silly. So it's much easier to go with it. And as you're taking that very first setup, that's 2,700 pips in the next 2 or 3 years, or roughly about $27,000 if you were lucky enough to hold on that entire time. So as we get into closing here, let's recap what our concept is behind this. Remember, the same thing my mentors taught me is the same thing I'm trying to transfer over onto you, and hopefully you'll be able to grasp that. And that is, there is no such thing as overbought or oversold. I think you can tell right now. In fact, go and do your own research. Go back and look at any chart, any time frame, any market. Sure, there are some stocks, just like the slot machines, that will come to an overbought area and completely reverse, or come to an oversold and completely reverse. Sure, you will see that every once in a while, just the same way someone will win at the slot machines every once in a while. But this technique is designed like the slot machines. They're designed to give you winners every once in a while. And you get this kind of confidence where you think it's working, but over time, using this, you will have nothing to show for it. Take it from someone who's been there. I almost had to quit my job on the floor because I could not make a dime. So remember, if you finally grasp this, I really feel confident that you'll get on your road to consistency. And once you grasp this, if there's no such thing as overbought or oversold, then what is the real message? The real message is the same message that my mentors taught me, and that's never, ever try to pick tops and bottoms. Take it from someone who's been there. It's a recipe for disaster. It's a gambling mentality. There's no way you can ever, on a consistent basis, know when something will stop and turn the opposite direction. It's just too difficult, okay? I'm sure there are some traders there. In fact, I know of some who are able to trade this way and make a nice living. But they're probably the 1 or 2% of all traders. The rest of us, 98% of us, myself included, have a very difficult time doing that. So why try to be that 1% when it's just too difficult? Why not just go with it? Now, as we close here, before questions, I want to ask you a question and ask yourself honestly, do you think this edge could have helped your trading this past year? Look at your trading. We're already in the third month of 2017. Are you anywhere where you thought you'd be coming into the first quarter of the year? Most people never reach their goals and aspirations of what they promised themselves at the beginning of the year. How would you really like to get on board with your trading and have 2017 be the most consistent year ever? Well, here's what we're offering to all the attendees today for our association with Investor Inspiration. We're going to offer you our Secrets of a Stock Exchange Specialist training sessions. Now, about 5 years ago, I was asked to be the head speaker at a conference in Denver, Colorado. There were many other speakers there, but I was the head speaker, and I was able to speak for 3 hours. Now, during my conference there, I spoke about many more high probability trading edges, the ones that I didn't speak about today. I talk about which indicators to use, but more importantly, which ones not to use. I go into what the difference is between a system and a strategy. I share with you what I feel is the #1 chart pattern you should be looking for regardless of what market, what strategy, what technique you use. But I think the best thing about this 3-hour package, it's a video seminar, is that I give you the complete rules to one of our best and most consistent pullback strategies. Now, what I shared with you today was not a strategy. It was just the entry. It was just one piece of the puzzle. But in this video seminar, I give you all the rules: entry point, exit point, stop placement. I tell you how to trade it conservatively. I tell you how to trade it aggressively, okay? In fact, let me show you some signals that were generated for our Strategy #1 course members. Here's a chart in Halliburton. Now, someone looking at this would say, well, Steve, the chat room I go to doesn't like the stock because we kind of made a top here and it looks like we're really falling out of bed. In fact, we broke some really good support here and a Fibonacci support, and all the institutions don't like this, and it looks like this is the next wave down. Okay? Now, does that sound familiar? This is the way 99.9% of all traders trade. They're basing what the market's going to do off of outside sources. Someone telling them what to do, an indicator, a chart, tool or something of that nature, when they're not looking at the most important thing, which is the market, once again. Now, according to Strategy #1, it listens to the market, and it translated the market really wanted to go up. So it was just saying that the market was in an overall uptrend, and this was simply a pullback. So a buy signal was generated right here where everyone thought you should be selling it, and look what happened at the stock. Stock went straight up for the next 2 or 3 weeks, okay? Same thing happened here with PBI. A lot of people were calling for support and say, Steve, this is the institutions love this. The volume has really picked up. It really is a great support level. So I think this is, if we come down here, I'm going to buy this again. According to Strategy #1, strategy translated that the market was going lower and that the market really wanted to go much lower, and this was just a pullback to the upside before the downswing. So it generated a sell signal right here, and look what happened the very next day. So I give you all of the complete rules to this strategy, all right? Remember, today I just gave you an entry technique. This is entirely different. This is a pullback strategy where you're trying to buy on the pullback within an uptrend or sell on a pullback within a downtrend. All the rules, and I think one of the best things about this is that it works in any market, any time frame, in any direction. Now, along with this, this is my sister site, which is Pro Trader Strategies. They've marketed this so much in this 3-hour video that they've actually marketed this for close to $1,000 on their website. But because of all the attendees today and our association with Investor Inspiration, we are drastically dropping this down just for a limited time only to $37. I can't think of a better deal of getting this much educational information jam-packed into 3 hours. And it's all yours. It's not something that's going to disintegrate after a couple of weeks. It's all yours for life. And I think one of the best perks about this is that you now have the ability to correspond with me. You will get my personal email address, and you'll be able to ask me any question you'd like. If something wasn't explained that properly, or you didn't understand it in the video seminar, you can contact me, and I'll go over everything with you. Okay? So you have me as your personal mentor through email correspondence. Remember, this is only for $37. It's a great, great deal. So here's how to take advantage of this. Now the link you see at the very bottom is the link that will take you directly there for that $37 sign up, but that's not a live link, so you'd have to simply copy and paste that. Just copy and paste that off of your browser if you can, and just take it onto another browser, and you'll be able to go there, or write it down right now and then put it up on your browser. If you're having difficulty, go to my sister site, which is Pro Trader Strategies. They are, as my sister site, once again, they handle all my marketing and promoting of my courses. You can call them directly at area code 310-598-6677, and they can answer any question you may have. But remember, that $37 deal is only going to be lasting for the next, I believe, 24 or 48 hours. If you wait too long, it's going to go back up to $1,000. So I can't think of a better way to spend, you know, I don't even think you can spend less than $37 to go out to dinner these days for two. In fact, many of you trading today probably have already spent more than that in your commission costs alone. Now I see on the right-hand corner, Renee has posted on the chat box the live link. So actually, you don't have to copy the link at the bottom. You can simply go to the chat box and you can click on that live link in the Go to Webinar column there, and it will automatically take you to the sign-up page. Okay. So I don't want to step on the next person's segment. So that's pretty much it. Let me see. I'll open up just for a few questions. So Stephen, could you use your system on gold futures at current prices? Sure. Now, once again, I've said this, but for the people who came in late, what I share with you today, and also strategy number one, can be applied to any market, any time frame, and any direction. So don't worry if you trade currency pairs. Don't worry if you intraday trade commodities. If you trade gold futures, it makes no difference. Wherever there is a trend and wherever there are people saying something is overbought or oversold, you can exploit it. So it will work great. Now, I know people are saying, well, where do I place my stop? Where do I get out? We're just giving you the entry technique today. But in the course, on the $37 deal, we talk about stop placement and exit. So you can use those if you'd like to apply for this technique, okay? The 50-period moving average, people are asking about that. That's virtually on any charting software package. It's just a moving average of whatever time frame you're looking at. So in other words, if you're looking at a 5-minute chart, it's an average of the last 55 minutes, okay, of the last 50 bars that are 5-minute bars. If you're looking at a daily chart, it's the last 50 daily bar charts, okay? You don't have to look at a higher time frame to discern what the lower time frame is doing. I mean, in my 40 years of trading, I found no consistency in that. So it's not required. Just look at the chart you're trading. Keep things as simple as possible, and I really feel you'll get onto that road to consistency, okay? I think my time is just about up. There's all the information you need. I want to thank you so much for attending. I hope you got something out of this, and I look forward to all of you becoming students and members of mine at Specialist Trading and Pro Trader Strategies. Thanks again to Investors Inspiration, and I look forward to seeing you next time. Thank you. Bye-bye.